Hello, my name is Sandy Hood, and I've been asked by Ashley if I could possibly explain sales variances. I think this is particularly useful as far as the operational case study is concerned, and we could have just this kind of a question in one of the variants in the February 2026 exams, which are coming up very soon. So what are we going to do with a sales variance question? We need to look at giving the examiner an explanation of what the variance is. Now, this doesn't have to be with any application at that stage. It could just be one sentence, it might be two sentences. Just what is it that this variance is? How can we explain the variance? Then we move into application, absolutely definitely, showing the data that we've got and how that fits into the way in which the variance is calculated. And then finally, we need to explain the likely reasons why that variance has occurred, and invariably we've got that information somewhere in the data that's given on the reference material. I'm going to look at Halfpenny. Halfpenny was the exam in March 25 and August 25. Here's a little bit of background. A company that produces and sells packaged bread. The company is based in Kieland, in a small country in Europe, where the currency is the K dollar. Halfpenny currently produces a range of packaged sliced bread loaves and packaged bread rolls. Bread loaves and rolls. All of the products until now was sold business to business, and the company did not sell direct to consumers. Sales prices and credit terms vary by retailer and are negotiated by the respective sales team. On average, sales prices for larger retailers are 20% lower than for small retailers. Right, so that's the background. That's essentially come from the pre-scene. We've now got the information from the variant. They've recently considered to extend their product range to include gluten-free bread products. So this has come from the May-November 25 examiner's report and section 4A of variant 2. Okay, let's read what you'd have on that day. It's now February 2026. Well, it virtually is. It will be very soon. And Halfpenny was launched to the market in December 25, and consumers are able to buy the range through two sales channels, from retailers large and small and through the subscription ad. So here we've got the beginnings of selling direct to consumers. You receive the following email from Evita Gomez to yourself, the finance officer, and that's what you will be in this exam, finance officer. Only you'll be finance officer at some tricks. Sales variances, KPIs and financial statements. Okay, I've only taken subtask A, so we're only looking at sales variances. Senior management team have asked for a review of the sales performance in January for the GF, gluten-free in other words, Halfpenny across our two sales channels. Lottie Phillips, the finance director, suggested that we focus on the high volume products in the range, that is the white loaf. The relevant sales variances are included in Table 1. Please prepare a briefing paper which explains what the variances mean, possible reasons for their occurrence, and what the variances indicate about overall sales performance of the gluten-free white loaf in the period. 40% mark. So we've got some information here. We've got five variances, haven't we? And then we've got the sales price and the sales mix profit variances have been totaled. So we can see the variances. We can see the budgeted selling prices are after planned discounts. Sales managers have the authority to negotiate discounts with the retailers. And for January, the sales and marketing director authorised an unplanned discount for app subscribers if they committed to the app for the full 6-month period. Okay, so a little bit interesting here. Budgeted prices after planned discounts, but we've got an unplanned discount for app subscribers. Sales mix and quantity profit variances are calculated using the weighted average method and standard gross profit. And so the standard gross profits are retailers 88 cents per loaf, app subscribers $1.40 per loaf, and the weighted average 98 cents per loaf. Okay, so it's interesting there. I will comment on that on the next slide. So what have we got? We've got the retailers with the favourable variances for sales price and for the mix. We've got the app users with the adverse variance for the price and a favourable variance for the mix. Right, so budgets had included the planned discounts. The sales marketing director added an unplanned one. And the weighted average method was used for the sales mix variances. Okay, the standard gross profit for the retailers, lower than weighted average. The standard gross profit for app subscribers was a lot higher than the average. So we've pulled out some useful information there. In the exam, we would need to plan. So the question said what the variances in Table 1 mean, possible reasons for their occurrence, and what the variances indicate about overall sales performance in the period. Okay, so here I've got a breakdown. I know 40% would give me enough time, about 14.4 minutes of writing up time, which would let me do about 7 paragraphs. So looking at this, I'm going to try to do a definition and evidence for the sales price variance in my first paragraph, an explanation in my second. I think the sales mix, because it's weighted average, is going to be a little bit harder to explain. So I've put 3+, so that could be paragraph number 3. Paragraph number 4 would be the explanation. And then we've got the sales quantity variance. I think that we can probably get that a little bit quicker, but I've got that down as paragraph 5 and paragraph 6, and then the overall performance, another paragraph at the end. Interesting. Again, I've often said this, when we're dealing with variance questions, we sometimes have to break away from the CIMA generic aspect of splitting the traits evenly. But this could even be a single trait question. Right, so what do we know? The sales price variance is the difference between the standard price of the bread and the actual price charged for that bread, multiplied by the number of loaves sold. The retailer's variance is favourable. The price charged was higher than standard. The app subscriber's variance is adverse. The price charged was lower than the standard. Smaller retailers receive a lower discount than larger retailers. Okay, this is remembering from the pre-scene. If the proportion of smaller retailers was greater than budgeted, this may explain why the average retailer price was higher than the standard. Okay, so the actual price was higher than standard, which is why we've got a favourable variance. App subscribers who committed to a 6-month subscriptions were offered an unplanned discount. This reduced price may explain the adverse variance. Now the sales mix variance. The sales mix variance is calculated using the weighted average method. We find the budgeted gross profit for each sales channel based on the budgeted sales units and the standard profit per loaf sold. We then add both budgeted gross profits together and divide the total by the budgeted number of loaves sold. This gives the weighted average gross profit per loaf. If the proportion of loaves sold is different from the budget, variances are produced. The retailer sales have a lower gross profit per loaf than the weighted average. Actual sales to retailers was a lower proportion of total sales than budgeted. Okay. So if they've got a lower than budgeted proportion of the sales, and they are the lower gross profit, then this will increase total gross profit, and so the variance was favourable. This 0.88 is lower than 0.98. If we've got less 0.88s, it pushes up the gross profit. The app subscription sales have a higher gross profit per loaf than the average. We sold more on this channel than budgeted, so this led to a favourable variance as well. Sales quantity variance. The sales quantity variance compares the budgeted total loaves sold with the actual total, only we've adjusted these into the standard mix. So the actual total using the standard mix. More loaves were sold. This meant that the gross profit was $90,160 higher than budgeted, which is a favourable variance. Okay, this is a brand new market. Our original estimates for this market appear to have been understated. More consumers were attracted to our gluten-free brand, and the additional discount may have encouraged more consumers to sign up on the app. And finally, operational performance. During January, the impact of the total adverse price variance on profit is outweighed by the impact of the total favourable mix and quantity variances. The standard sales mix may be incorrect. More consumers have been happy to sign up to the app than we first anticipated. The additional discount may have drawn more consumers to the app. It will be important to see whether all gluten-free products have had similar results. So the marking scheme for level 3 requires us to explain with technical accuracy the meaning of the 3 types of variance. So that was typically our first sentence or 2 sentences. And if the explanation is mostly clear and the reasons given are mostly appropriate and have been drawn from the scenario, then that's going to help as well. And we need to have some consideration of overall sales performance. I think we've achieved that. I think we've scored a level 3. Thank you very, very much for watching. You can contact me by email at sandy@sandyhood.com. I'm on Facebook at facebook.com/accountancy tutor. I primarily have face-to-face classes in a hotel which is near to Arundel in West Sussex, and if you're interested, then please send me an email and I will try and give you more details. Thank you very, very much for watching, and very good luck in your exam in February.